Welcome to The Explainer. When you look at Southeast Asia's booming economy, the easy answer for why it's growing so fast is always foreign investment, right? But what if that's just half the story? Today, we're going to dig into some really fascinating research that uncovers this surprising dance between money and trust to find out what truly fuels a nation's growth. All right, so let's dive right into the heart of the puzzle. If you're trying to grow a country's economy, what's the real secret sauce? Is it as simple as just opening the floodgates and letting foreign cash pour in? Or is there something deeper, something more fundamental at play, like, say, how much you can actually trust the system?
So, our focus today is on a group of heavy hitters, the ASEAN 6. We're talking Indonesia, Malaysia, Thailand, Singapore, the Philippines, and Vietnam. And look, these aren't just random countries on a map. Together, they account for a whopping 95% of the entire region's GDP. So yeah, if you want to understand what makes Southeast Asia tick, you've got to understand these 6.
And to really get a sense of what's at stake here, just look at this number. This is from Vietnam, back in 2002, which is right when the study kicks off. The average economic output per person was just $435. Just let that sink in for a second. Okay, now let's jump forward to 2021 and look at Singapore. Their GDP per capita, over $77,000. I mean, that gap is just massive, right? It shows you the incredible potential for growth here. But it also begs the question, how on earth does a country make that leap? All right, so let's start with suspect number 1, the most obvious one, money. Lots and lots of foreign money pouring into a country. Now, the official term for this is foreign direct investment. You'll hear it called FDI. And for a long time, people have seen it as the ultimate rocket fuel for an economy. So what is FDI exactly? Well, it's not just money flying around in the stock market. Nope. We're talking about real, tangible, long-term commitments. Think about a company from, say, Germany building a new factory in Vietnam, or an American tech firm buying a big chunk of a Malaysian startup. It's not just cash, it's technology, it's know-how, and most importantly, it's jobs. But here's the thing. The research is pretty clear that FDI isn't some kind of magic wand you can just wave. Sure, it's an amazing engine for growth. It can fill capital gaps, bring in new tech, all good stuff. But it can also totally backfire. If a country gets flooded with too much investment too fast, or if it just doesn't have the systems in place to handle it, that money can actually end up doing more harm than good. Okay, so that's money. Now let's bring in our second suspect. And this one's a little different. It's less about cash and a lot more about character. We're talking about how well a country can control corruption. And really what that boils down to is trust. How much can you trust the system? Yeah, there's actually a formal measurement for this. It's called control of corruption. And it's basically a scorecard for how well a country stops people from using public office for their own private gain. I mean, are government contracts going to the best bidder or to someone's cousin? Are resources being used for the public good, or are they getting siphoned off in backroom deals? It's a really fundamental check on the health of a country's institutions. Now, this is where a really interesting debate pops up. I mean, almost everyone agrees that corruption is like sand in the gears of an economy, right? It just gums everything up and slows things down. But there's this controversial little theory out there that says in places with just mountains of red tape, a little bit of corruption might actually, and I'm putting this in quotes, grease the wheels, help get things moving. It's a wild idea, but it's a key part of this whole puzzle. Okay, so we've got our 2 main players on the board, foreign money and trust in the system. And usually studies look at these 2 things completely separately. But the big aha moment in this research, the real game changer, comes when you look at how they actually interact with each other. Because it turns out they're not operating in their own little silos. They are deeply and pretty surprisingly connected. So first things first, this study confirmed something we kind of already knew. More foreign investment, yeah, that leads to more economic growth in these 6 countries. Not exactly a shocker, right? More money means more factories, more jobs, more everything. And second, they also confirmed the other piece of common wisdom. The better a country is at controlling corruption, the better its economy does. Again, this totally makes sense. When a place is stable and trustworthy, it's going to attract better investors and make sure that money actually gets put to good use. But this is where it gets really, really interesting. See, the researchers didn't just stop there. They used this special kind of analysis to see how these 2 things, money and trust, actually influence each other over time. They were looking for feedback loops. And this is the point where that simple, tidy story of more money equals more growth just starts to completely unravel.
And bam, here's the first big twist. It turns out that when you attract all that foreign investment, you're not just getting cash, you're often importing higher standards too. See, big international companies, they demand things like transparency and the rule of law. And that puts real pressure on the local government to clean up its act. So get this, the money can actually help build the trust.
But hold on, because there's a part two to this twist, and it's a real head scratcher. In the short term, and we're talking like the first year or so, cracking down hard on corruption can actually make some foreign investment run for the hills. Now, why would that happen? Well, it goes back to that whole greasing the wheels idea. Some investors might have been used to paying their way through the red tape, so when you suddenly clean house, it throws a wrench in their plans. It's a classic case of short-term pain for long-term gain. So the whole takeaway is summed up perfectly in this quote from the study. It's not a simple one-way street. It's not like money does its thing over here and trust does its thing over there, and they both help the economy grow. No, it's way more complicated. It's like a complex dance, where they're constantly influencing each other, sometimes for the better, sometimes for the worse, and it all plays out over time. So what does this all mean for the leaders in these countries? How are you supposed to manage this delicate balancing act between attracting money and building trust when they're so tangled up with each other? Well, the paper lays out a pretty clear roadmap. It says, first, be smart about the kind of investment you attract. Go for the high-tech stuff that plays to your strengths. Second, you've got to protect those investors with rock-solid, predictable rules. Third, and this is so important, you have to be relentless in fighting corruption, even when it feels like it's causing problems in the short run. After that, build strong systems to actually detect and prevent corruption. And finally, give your own citizens the power to call it out when they see it and hold people accountable. So at the end of the day, what this all really shows us is that when you're looking at something as complicated as a national economy, the obvious answer is almost never the whole answer. This dynamic between money and trust in Southeast Asia is a perfect example of these powerful, hidden feedback loops that are always at play under the surface. And it kind of leaves you with a bigger question, doesn't it? What other crucial connections are we completely missing in all the other complex systems that shape our world?